This is Wendy Sweet and my awesome brother,
Bill Fairman.
That's him. That's him. So we are so excited.
By the way, welcome to the show.
Yeah, that too. I always get down to business, don't I? Always get down to business. Even when I start to send an email, I need to remember to say hi or good afternoon, or even someone's name would be good, but I just get right down to it.
And just like me, when I say, I need 5 minutes to talk, send me an email.
Yeah. Billy's one of those water cooler guys that, you'll stand out there and, shoot the
Wendy's
bull
like,
for...
Nobody got time for that.
Yeah, come on, let's get to work. Ready to go.
Speaking of which.
That's right. We are really ready to go. So we, spent the last show, if you were smart enough to tune in, we spent the last show talking about our ideal borrower. And on this show, we really wanted to talk about the ideal lender investor that we like working with, right?
Sure.
All
absolutely.
Right. So what's your thought on that, Bill?
So we have a fund that allows for accredited investors to invest in this fund, and that's where we get the money to make our loans with.
Right.
We also
Plus
have
we have two more funds coming along, right?
Yeah. And yes,
awesome. We do.
And we also have other opportunities for non-accredited investors to invest in fractionalized loans. But that said, our ideal investor in the fund is going to be an accredited investor. Accredited means that you have a $1 million net worth. Now, net worth is your assets minus your liabilities. So one of the things you can't use in your net worth calculations is your primary residence. The benefit of not using your primary residence is that it's usually your largest debt.
Yeah.
The downside,
unless you're a really good investor.
The downside of not using your primary residence is usually your largest asset.
That's right.
So it washes. Now, there's also an income side to that. So if you don't qualify on the net worth side of things, it's $200,000 US for a single person. You've had to make it for the last 2 years, and assuming you're going to continue that. And then for a family, it's $300,000. Now, just because you make that kind of money or you have those kind of assets doesn't make you our ideal investor. When you're investing in a fund, it is a passive investment opportunity. And what I mean by that,
quit ruining our life,
is that you're really giving all the control over the investment to the manager. Right. You have to trust us that we know what the heck we're doing.
Right.
And it is truly passive. Now, there's a benefit to that. I mean, you have a full-time job. You don't have time to look at every single deal. You don't want to look at every single deal. We do all that work for you. If a deal goes bad, we're the ones that are taking it back and dealing with the foreclosure. I mean, it doesn't happen very often, but those are things that happen. And, we're there to take care of all that, all the servicing of the loans.
The due diligence on it in the first place, right?
It's very beneficial that you can get a decent return, allow for compounding over time, and you're still invested in a solid asset, such as real estate, single family residences, multi-tenanted commercial properties, and you're not the one having to do all the work. But at the same time,
goal,
right? That's right.
That's what passive means.
And at the same time, you have to be willing to let somebody else do the work for you, because there are personality types that just like playing the game.
Yeah.
And if you're one of those types that, and listen, we're self-employed.
Mm-hmm.
All right. So if you're one of those that has to have your fingers in every aspect, it's investing in a fund is not for you.
That's right.
Fractionalized loans might be, because our notes, that way you have more control over what it is that you're doing.
Yeah, and you can be a little more involved.
But funding investing might not be for you. A lot of the engineering types have a hard time with that. And you know who you are.
You know who you are.
If you're a control freak, it's not for you. But that doesn't mean you don't have opportunity.
That's right.
It's just not, you're not going to be in the fun thing. Now, our ideal investor really has about 3 to 5 million in investable capital. And why do I say that? It's because our minimum investment is 50,000, while most people put in 100. We don't want it to be your last 50 or your last 100.
Right.
We want investors that have the wherewithal, that understand that there's nothing ever guaranteed, and you're just going to sleep better. If it's your last $50,000, you need to be investing it in a mutual fund in the stock market.
Right. Something extremely
or
safe.
a money market at the bank, or a savings bond.
Mm-hmm.
Okay.
Mm-hmm.
But that ideal client is someone who really has been kind of fed up with the stock market, and they're looking for the alternative, because frankly, and if you're a real estate investor, you probably agree with this. We kind of feel that the stock market is rigged, and it's only the professional traders and the big companies that are making all the money.
That's right.
By the time the average investor gets into a particular stock, all the money and the value has been taken out, and you're getting the little crumbs at the top before it starts to come back down again, or most of the growth part of the value is gone. Now, there's other investments that are very safe in the stock market. Utilities, something that pays a really good dividend, but you're not going to get any growth out of those. You're basically just getting an income dividend. Now, it's really important too that if you we're kind of talking tax strategies now. A fund like ours that is a mortgage-based fund is a great opportunity to invest an IRA, traditional IRA, solo 401k, Roth IRAs, because in our type of fund where all the income is derived from mortgage payments, interest due, there are no tax benefits. You're going to pay tax on the money that you earn, whether you're compounding it over time or whether you're actually getting a check every quarter. You're still going to owe taxes on it at the end of the year. So if you're doing it in a tax deferred or tax exempt vehicle, then that's really the best place to do it. Now, I've always been of the mind, you own property with cash, you make loans with your IRA.
Right.
Because you can't take advantage of the tax advantages that the government gives you in a property if you have it in a tax deferred account.
Right.
What's the point?
That's
It's
right.
already tax deferred. So the best way to leverage all that is to lend out of your IRA, and our fund would be lending.
But then cash too can go in a fund that owns property, and you could take advantage of those tax situations. Right. Which is why we're starting another fund as well.
Well, we're not
having some of those options available.
Yeah, and there's not going to be a lot of real estate being owned in the fund, but there'll be opportunities in there for that.
For different kind of stuff like that. So.
And then at the same time, the fractionalized notes gives people an opportunity, if you're not an accredited investor and you also like to have a little bit more control, you can do that. So,
meaning you can pick the property you want to be in.
I want
that kind of thing, right?
Exactly. So the reason I keep pointing out the passive piece of it.
Why do you do that, Bill?
Is, we talk about our ideal investor, one who calls us and says, "Thank you for the growth."
That's right. I really like seeing that check get into my bank account. That was nice.
One that is not calling me and wants to know the detail on every single 75 properties we have in the fund. Now, again, part of that is trusting your manager.
Absolutely.
We have a third-party company that does the books. We have a third-party company that does the tax returns. We have an additional third-party CPA that does the annual audits.
We got a lot of parties going on.
So we have three sets of eyes looking at the books. But at the same time, we have a tough job doing what we do.
Absolutely.
And I'm sorry I keep harping on this, but if you're the personality type that has to get involved, choose notes.
We've got some numbers you can call. Right.
So, we've been rambling on about this ideal investor here, and I'm sure I can come up with some stories that you guys would find humorous. Not necessarily the investors that the stories are about.
Yeah.
So on our next show, we're going to talk about what to expect, or what an investor can expect in our fund or lending through notes as well. Don't forget to because we get paid by the likes.
That's right.
Subscribe
They like me,
to
they
our
really like
channel.
me. Right.
And you can also visit us at carolinahardmoney.com. You guys have a great day. We'll see you on the next show.
Hi, if you really like this show, what you can do is you can check out some of our other shows that might or might not pertain to it. You can check up there, you can check over here, you can check down here. Check it out. Don't be afraid to like us, right?
Subscribe.
Do that too. Subscribe to our page and hit like. We'd love to have you do that. Thanks.